Hey traders, welcome to Charts and Coffee. Happy Tuesday, Wednesday, everybody. Happy Wednesday. How could I forget? Today is the big day for our webinar tonight at 8. So if you haven't registered yet, check it out at simplertrading.com/consistency. More on that later. Let's talk about what we've got going on right now in the indices. We had a lot of earnings yesterday. Now, keep this in mind during earnings season. The impact on earnings on the stock, obviously itself, is a very different conversation than the impact of that stock on the broader averages. If you think about the weighting of, say, an Apple or a Microsoft, Magnificent Seven, why are they magnificent? Are they necessarily in uptrends? Are they necessarily outperforming? No, it's their weighting, right? So because of their weighting, there's a lot more impact that goes far beyond just the gap that we might see on that stock. So names like, say, PLTR, while very much a social sentiment kind of name, they're not necessarily going to be big market movers because it's really a stock that's sort of limited in its impact, in its influence, in its weighting on the broader averages. So we always want to differentiate between what's interesting and sort of out there in the social sentiment like PLTR, and then what might be far more impactful, like, say, a Google or a Broadcom or these high concentration weighted names. So, during earnings season, let's always make sure we're aware of the weighting of that stock in the broader averages. That said, taking a look at the NASDAQ. Oh, and by the way, I should rewind just a little bit. You might say, Rog, how do I know what's coming? And I'm not a fan of, hey, this earnings is coming out tomorrow. The window for opportunity with that type of timeline is very limited. Sometimes the best setup in front of earnings is weeks in advance, taking advantage of the rally into earnings, the run up into earnings, as opposed to the binary, does a gap up or gap down? The latter, I just don't do. However, in order to be able to take advantage of things 2, 4, 6 weeks out, you need a very different kind of calendar. Most traders look at earnings calendars where it's a cutesy little Monday through Friday calendar with the logos put all over it for this week. That's too soon. Meaning we're looking at these things in such a way where these things are coming up soon. And really what that means is it's just really too late to avoid the implied volatility. You're putting yourself in potential harm's way via vol crush if you're going to hold the option. All these different pitfalls that traders who trade earnings tend to struggle with, right? But if you look at earnings as something off in the distance that traders will be gearing up for, jockeying position around, and you can start that watch list weeks in advance, you're in good shape. So what I use the calendar over at Estimize that isn't just giving me what's happening today and tomorrow. That's really not that helpful. What I want is something that's going to tell me what's happening at the end of this month, say 2 weeks from now, a month from now. So if you're asking, Rog, what are you gearing up for? Right now, I would be thinking about CRM, Costco, Lennar, Oracle, FedEx, Nike, Micron, right? Those are the names that I'd be thinking about going into. It's really the tail end of the high impact stocks for earnings season. Not things, and I wouldn't look any sooner. What's the cutoff? I'd say no sooner than the 19th or the 20th. So that still leaves plenty of high impact stocks on the list. I want to be at least 2 weeks out before that implied volatility starts to get too crazy. And I don't want to be relegated to my trade simply being, oh, am I really right? Because earnings were better or worse than expected. And we also know that earnings can be good and the stock can gap down, right? These are all the different things that make earnings season a very interesting spectacle, but not always a really good way to trade unless you're looking at it far in advance and just using the psychology of earnings, not the results. All right. Question here on Boeing. is it's starting to shape up a bit. There's a couple things that Boeing has done since December, Jas, that makes it a little bit more interesting. I don't put this on my radar quite yet. I wouldn't. However, you're absolutely correct. There are some huge things that happened between December 11 and December 16. So in those 5 days, we not only broke above the equator, that's those series of white dots going across my screen there, it came back down and tested that area, and then it tested it again on the 14th. And that shows us that Boeing is willing to stay. And isn't it interesting that those wicks are precisely where those dots are, right? So that's why I call it the equator. It's a difference between the bullish and the bearish hemisphere. And we're staying in the bullish hemisphere. So with that being said, yeah, for the first time in a really, really long time, we can think about Boeing to the long side. And it's been since August since I would even dream of doing something other than a long put in Boeing. Now we can at least talk about long calls. But before I get ahead of myself on something like Boeing, and I always teach our traders to think about building a watch list as a sorting process and a comparison process. And that's why I use that old book title, which is so great, Trade This, Not That. That's what I teach traders. So trade this, not that. Now, if I take a look at Boeing, I'm going to either be looking at the XLI as far as comparing stocks that are in the same kind of group as Boeing. I think I have to sneeze. All right, maybe I can keep it at bay. Okay. All right, so I want to look at groups. Let's take a look at BA right there. Are there other stocks in this group, Jas, that would get my attention in terms of setting something up to the long side? So Boeing, this is Boeing's look on the daily time frame. And we always have to be time frame specific, gang. If you're ever wondering, Rog, what are you doing predominantly in charts and coffee? And what are you looking at predominantly in the Sector Secrets Mastery? The 5-minute for day trading, the 1 hour for short-term swing trading, and the daily time frame for longer-term swing trading, and then position trades that could be 6 months or longer. That's the weekly. So every time frame has its job. And it's little nuances like this that make the biggest difference between being a consistent trader and growing an account and being an inconsistent trader. And, we've been talking about, who here remembers that game that maybe you remember as a kid? It was Chutes and Ladders. Who remembers this, right? Who remembers this? Am I slicing into anyone's childhood here? Yeah, most traders' P&Ls look like this. Oh, we're doing great. Oh, we're doing fantastic. Woo. And they wonder why they can't grow their account. It's got to be like that little yodeling dude on The Price is Right. I'm totally dating myself. You want that consistent account growth. We'll be talking about that tonight because there are specific types of trades to avoid. There are specific types of trades to make the focal point of an account growth objective. There are certain tools, there are certain expiration dates, and those are all be things that I'll be talking about tonight. So if I look at Boeing and I compare it, this is the process, right? This is why profitable trading starts with the watch list. This is why we have to spend a little bit more time saying, look, why RTX, not let's set up RTX, or why GE, let's set up GE. That's a very different conversation. So before I get to even setting Boeing up, I want to make sure that I'm looking at the best stock in that group. And frankly, GE and RTX are likely slightly better choices. And that's where it's not a matter of, I'm not saying Boeing can't keep moving higher, but what I'm saying is if I'm looking at probabilistic setups, what has the probability of continuing higher? What has the probability of continuing to climb? Something that's already climbing, right? Something that's already, through the tools that I use, showing bullish participation, bullish price action, and the kind of structure where I would expect higher highs and higher lows are still to come, right? So yeah, I would have no issue with BA. I just think it's a little further down the watch list of things that I would want to do. So Jas, thank you for the question, and really nice heads up on that, because really before something ends up on our watch list, it has to exhibit certain types of behavior, and to be on top of that, right, is going to allow us to be putting the best symbols in the pipeline, right? So BA might not be there yet, but it's definitely something to keep an eye on. All right, next up is Jawan asks, what's up with AMD? What's up with AMD? Well, so let's do this. If I look at anytime I'm looking at what's happening with a stock, I'm always going to start with earnings or earnings in similar niches. AMD just had earnings. That's what's up. Uh, so when we look at what's happening with AMD, right? Why is it continuing to go lower? Let's talk about probabilistic thinking and why anything looking long in AMD is just ignoring market structure, and how long ago could we have known? So this is a neat question from the perspective of A, this is why we don't want to trade earnings, and B, this is why, in this case, the ramp down into earnings made so much more sense. So look at how long AMD has been printing red candles predominantly. Started back at the end of October, and it's been nothing really but that since the end of October, right? End of October, beginning of November. Red candles tell us chances are the probability of continuation to the upside is very slim. And so instead of buying the dip, we short the rip. What is the difference? Buy the dip is things are going up, it pulls back, we buy a call, and the expectation is for continuation upward. In a sell the rip, we wait for the market to move up into that rip or bounce, right? We buy puts with the expectation the market's going to continue to move downward. And that's exactly what AMD's done. Now, if you're setting up AMD 6 weeks, 4 weeks before earnings, this is that ramp down into earnings. So the expectation is I'm going to continue to sell the rip, buy calls on bounces, and now we get earnings, and it doesn't matter what the earnings are, gang. Don't get caught up in, but AMD beat or this stock beat. Forget all that. The reaction's all that matters. Don't get caught up in the, trading earnings is like a trader saying, you know what? I want to quit trading and I want to go into professional scratch off lottery ticket career. I mean, that's kind of the way my brain thinks about it. Think about the probabilities of a downtrend continuing versus a binary event where we get a sudden burst of earnings and a sudden re-discounting or re-jockeying for a position based on what we know. Look how good the downtrend was, right? Look how good it just consistently went lower, below 150. And then, would the lower low in the wake of earnings be a surprise? No, I mean, if something surprising happened, it could be up at 140 right now. This is why I hate earnings season. But if you think about the calmer setup, the more structured setup before earnings, yeah, it's definitely bearish before and it's bearish after. So that's what's up with AMD. It's continuation, right? It's just continuation. All right, next up is any thoughts on long CALM? All right, Calmain. So the way I would look at Calmain, and again, I'm not going to go up the food chain, so I'm going to presume, right? You do all the homework and you look at the stocks in the same group, et cetera, et cetera. Green candles, right? So this is kind of the opposite of Jawan's question about AMD. Forget the earnings, right? What's the structure of this chart? Imagine yourself, and this would probably serve a lot of traders because this was the advice that I was given, and I operated like this for 10 years. Imagine yourself a hermit in a cave. Shut the news off because, my gosh, nothing on financial media is ever going to make you, turning on the TV is never going to make a trader better or a better investor, right? That's like saying if I turn on ESPN, I'm going to be able to hit a golf ball better, or I'm going to be able to throw a football more accurately. Like, no one thinks that when they turn on ESPN, and yet everybody thinks that when they turn on whatever, fill in the blank, any number of the financial media channels that are out there. So that said, turn off the TV. Imagine you're a hermit in a cave, and all you've got, for whatever reason, are charts. No news, just charts. And if I look at COM, it's bullish. The last trend that we saw at the beginning of December was bullish. This is why I rely on my tools. Again, it's not that every time they're going to be right. Nothing's right every time. But I know probabilistically I'm going to be more on the right side of things on the follow through side of things than not. In the case of bullish chop, what I would say to do is be a buyer somewhere between 98.5 and probably about 107, 108, right? The closer you are to the lower part of the range, I would even get a little bit more specific, maybe 105 to call it 99. In that lower part, the lower third, if you will, lower half of this range that COM has been in, what that allows you to do is if price bounces to where it continues to struggle with follow through, right? Momentum traders will see a move past 114, and what are they going to do? Well, we've seen what they do. They buy. They bought again. What does that tell you? Are all environments ideal for breakout trading? No. However, and I'm biased, but all environments are valid for exhaustion trading. What do I mean by that? I'm not going to buy a high here. We're not in an uptrend. You can get away with that in uptrends. Momentum traders, that's why your average retail trader loves uptrends, because they can buy whatever they want pretty much at any point in the chart. And because the overall movement is so strongly up, they're going to be right. That's not good trading, though. It's certainly not a good understanding of risk reward, which is what trading is. So rather than getting suckered into, this is often called a whipsaw, right? False breakout. Instead of getting whipsawed into that north of 114, we buy lower in the range, preferably in the lower quarter, maybe the lower third of the range. And what that allows us to do, and this is what I teach. I did a video on this, I think last Friday, exactly what I'm teaching you all here. This is one of the strategies that you're going to be able to use in 2025 that's really going to help you grow an account. But it's a different type of timing, right? And I have examples on that in tonight's webinar. So if you want a little bit more, a live example of something we did, check out the webinar tonight, and I'll be going through an example of this type of setup. I call it cutting the sandwich in half, right? So here's our sandwich, cut it in half and cut it in half again. If I can buy in that lower quarter, lower third, when we get back up to this place of a false breakout where it keeps failing around 114, maybe call it 113.90, I'm going to pay myself when I can, not when I have to. And that way I'm doing what? Bing, growing an account, right? Now, what if it keeps going? That's phase 2 of this trade. I'm in at a really great risk reward. I'm in at a far better price than chasing this thing higher with calls at 114. So if it does pull back, great, right? Fantastic. And then if it fails, I've done my job. I've paid myself. So hopefully that helps. And then we'll go from, well, see what happens, in terms of the structure that we see here. Does it continue to move sideways? Like every day I'm going to reassess. Is this a trend? Is this not? Is this bullish? Is this not? So I'm going to continue to look at the color of the candles. And gang, by the way, if your indicators are not giving you that level of day-to-day understanding, candle by candle understanding of the sentiment and the trend, you need that as part of your toolkit. You don't have to stop what you're doing now. What I teach and the indicators that I use don't have to replace anything that you're doing right now that you love. You might say, Rog, I love trading breakouts. Cool. There's an environment for that, right? Rog, I love overbought, oversold. I love when markets are going back and forth within a range. Fantastic. There is an environment for that. So what a lot of traders find is you don't have to change what you're doing. This process is going to make whatever you've been doing work far, far better, right? If you don't have a process and you don't have a preferential type strategy, great. I'm going to give you one. And it's going to be oriented towards trend following, because that's what I've been doing for over 30 years. And it just works. It's Physics 101, a body in motion, right? So that's what we want to think about our trading. So however we are trading right now, you can grow an account. It's usually just a matter of little nuances of, oh, Rog, I didn't know that this environment for this indicator and this strategy wasn't as good, right? And maybe you weren't told. So we're going to cover all sorts of things like this, because 2025 is presenting a lot of different challenges as compared to 2024, right? Lots of different challenges. So we want to be ready for it. And we also want to remember beyond 2025, there'll be quarters like 2024, Q1, where it goes straight up, and there'll be quarters like 2025 where it's choppy. So imagine you know how to A, recognize it, and B, how to trade it. We're going to get into all that tonight. So again, if you haven't already registered, it's simplertrading.com /consistency. Bring a notepad, bring your questions. We're really going to get into it tonight. Okay, be good to each other, gang. I'll see you tomorrow. Same time, same station.